Hey everyone, if you're gearing up for your CA exams, you know that the cost of capital question is an absolute classic. You've got to master it. So today, that's exactly what we're going to do. We're going to take a typical exam question and just tear it down, piece by piece, so you can feel totally confident when you see it on your paper. Let's jump right in. So before we get buried in formulas, let's just ask a simple question. What are we really trying to figure out here? Well, every company runs on money, right? Whether it comes from selling shares or taking out loans. But here's the thing, that money is never free. The cost of capital is just the price a company pays to use that money. And knowing this number is absolutely crucial for making smart investment decisions. Here's our roadmap. First, we'll get a grip on the problem itself. Then, we'll calculate the cost of equity and the cost of preference shares separately. After we have those two pieces, we'll blend them together to find the big one, the weighted average cost of capital, or WACC. And finally, we'll wrap it all up with the key things you need to remember. All right, section 1. Let's understand the core problem by digging into the data we've been given. Okay, here's what the exam question gives us to work with. We've got two sources of funding, regular equity shares and some 8% preference shares. Now pay close attention to the additional info. We've got a market price for equity of 60 rupees, a flotation cost of 4 rupees, that's the cost of issuing new shares, and a recent dividend, what we call D0, of 2 rupees. And importantly, that dividend is expected to grow by 5% a year. All the clues we need are right here on this screen. First things first, let's figure out the cost of equity, which we call K sub E. This number is so important because it basically answers the question, what's the minimum return our shareholders demand for putting their money and their trust in us? You see, the cost of equity isn't just about the dividends someone gets this year. It's actually a mix of two things, the immediate return you get from the dividend and the potential return you expect to get down the line as the company and its dividends grow. And to figure that out, we're going to use this powerful tool right here, the Gordon Growth Model. Now, I know formulas can look a bit intimidating, but don't worry, we're about to break down every single part of this D1, P0, F, and G step by step. All right, let's plug in our numbers. Step 1, we need D1, the dividend we expect next year. The problem gave us D0, the dividend that was just paid, which was 2 rupees. So we just apply that 5% growth to it, and that gives us our D1, 2 rupees and 10 pice. Easy enough. Step 2, what does the company actually get when it sells a new share? Well, the market price, P0, is 60 rupees, but we have to subtract that 4 rupee flotation cost, F, so the net proceeds are 56 rupees. Step 3, now we just put it all together. 2.10 divided by 56, plus that 5% growth rate. And there we have it, 8.75%. That is our cost of equity. It's the first major piece of our puzzle, so make a note of that number. We're going to need it later. All right, next up, the cost of preference shares, or K sub P. And I have some good news for you. This one is way more straightforward. Why? Because preference share dividends are fixed, so we don't have to worry about any growth rates. The magic word here is fixed. Preference shareholders are promised a specific set dividend every single year. It doesn't grow, it doesn't change. That predictability makes the calculation a simple comparison between that fixed dividend and what the share is worth on the market today. And the formula is just as simple as the concept. The cost, KP, is just the annual preference dividend, DP, divided by the market price of the preference share, PP. That's it. Okay, let's do this. Step 1, find that annual dividend. The problem tells us these are 8% preference shares with a face value of 100 rupees. So 8% of 100 is 8 rupees. That's our fixed dividend. Step 2, we simply divide that 8 rupee dividend by the current market price given in the problem, which is 55 rupees. And that gives us 14.55%. That's our cost of preference shares. So now we have both pieces of the puzzle. We know what equity costs and we know what preference shares cost. So what's the last step? It's time for the grand finale. We're going to assemble the WACC, the weighted average cost of capital. All we're doing here is taking the two costs we just found, that 8.75% for equity and the 14.55% for preference shares, and blending them together to find one single overall cost of funding for the entire company. Now, we can't just take a simple average. We have to weight them based on how much of the company's value they represent. And we always use market value for this because it reflects the real, current cost of raising money. So we take our 1 million equity shares and multiply by their 60 rupee price. Then we take our 500,000 preference shares and multiply by their 55 rupee price. Add them up and we get a total company market value of 8 crore 75 lakh rupees. So what does that total value tell us? Well, it shows us that equity makes up about 68.6% of the company's capital structure, and preference shares make up the other 31.4%. These percentages are the weights we need for our final calculation. And here is where it all comes together. We take the weight of equity and multiply it by the cost of equity we found earlier, 8.75%. Then we add that to the weight of preference shares, multiplied by its cost of 14.55%. See? We're literally calculating a weighted average. And when you run the numbers, you get our final answer, 10.57%. This is the company's weighted average cost of capital. Think of it as the minimum return the company has to earn on any new project just to keep all of its investors, both equity and preference, happy. We did it. We've solved the problem. So, we've done all the hard work. We've crunched all the numbers. Now let's move to the final section, our answers and key takeaways. Let's quickly recap what we found and, more importantly, what this all actually means. Here they are, our 3 key results all in one place, exactly how you'd want to present them in your exam. The cost of equity, K sub E, is 8.75%. The cost of preference shares, K sub P, is 14.55%. And the blended overall weighted average cost of capital, the WACC, is 10.57%. Seeing them all together really helps lock in the entire process. But why on earth did we go through all that trouble? Well, that WACC number isn't just for an exam. In the real world, a company uses that 10.57% as its hurdle rate. Any new project, any new investment they're considering has to promise a return that is higher than 10.57%. If it doesn't, it's not a good investment and won't create value for shareholders. And that really brings us to the final big picture idea. Calculating your cost of capital is just the first step. The real game for any company is finding projects that can consistently beat that number. So, knowing their WACC is 10.57%, how does a company sort through all the possibilities and pick the ones that will truly grow the business? Well, that's the next fascinating chapter in the world of finance. Thanks so much for joining me today.